Hello, everyone, and let me start by apologizing for the slight delay to the start of our of today's event. We're here to discuss In the Trail of Capital Flight from Africa, an important new book on the subject of capital flight, which investigates the dynamics of capital flight from Angola, Cote d'Ivoire, and South Africa, all three countries that have witnessed large-scale illicit financial outflows in recent decades. The book uses quantitative, qualitative, and institutional analysis for each of these three countries to examine the modus operandi of capital flight in each, that is specifically the who, the how, and the where dimensions of the phenomenon. Who refers to major domestic and foreign players, how refers to mechanisms of capital acquisition, transfer, and concealment, and where refers to the destinations of capital flight and the transactions involved. The evidence that the book puts together reveals a complex network of actors and enablers involved in orchestrating and facilitating capital flight and the accumulation of private wealth in offshore secrecy jurisdictions. The book, amongst other insights, underscores the extent to which capital flight really is a global phenomenon, and the measures that truly curtail it would have to be a shared responsibility, not just for Africa, but for the global community more generally. I found this book, as I said, extremely insightful. It's an important marker, not just to those interested in the global mechanisms of capital flight, but also to an audience interested more broadly in African political economy. Professors Leon Ndikumana, James Boyce, and their co-authors in the book provide cutting-edge analysis of both the sources of capital flight, but also the destination of these stolen funds. They marry the best available work on the economics of capital flight, on which Professors Boyce and Ndikumana have done a lot of work over many years, with insightful case studies, and they show the importance of bringing together fine-grained qualitative analysis with the best quantitative work for understanding the consequences of capital flight, not just for Africa, but for the global economy more broadly. So it's a great pleasure to receive the two editors of the book and one of the authors of the chapter on Angola in the book. Let me start by introducing Professor Leon Ndikumana, who's a distinguished professor of economics and director of the African Development Policy Program at the Political Economy Research Institute at the University of Massachusetts Amherst. Professor Ndikumana is also an Andrew Carnegie Fellow, an honorary professor at the University of Cape Town and the University of Stellenbosch in South Africa, and the author of a distinguished range of publications on the subject, going back more than 20 years, in fact, in collaboration with Professor Boyce and with other authors. Professor James Boyce is a senior fellow at the Political Economy Research Institute, also at the University of Massachusetts Amherst. He's has many previous publications, including more recently a book called Africa's Odious Debts, How Foreign Loans and Capital Flight Bled a Continent. But I would really emphasize the extent to which Professors Boyce and Professor Ndikumana have been at the forefront of research on capital flight out of Africa for a very, very long period of time. I would also like to introduce Nicholas Jackson, who is an author of very distinguished books, verging from a book called Poison Wells on the politics of oil in Africa, to The Finance Curse, and also Treasure Islands, one of the landmark books on offshore, on tax havens. And Nick specifically wrote the chapter on Angola for this book, and it's with great pleasure that I pass the word to Leon Ndikumana for the first presentation. As discussed, I asked the speakers to keep their comments to about 10 minutes so that we can have a significant interaction, not just with the online audience, who will be sending in questions and comments, but also with the three speakers. We hope to have time to return to them and to engage them in further discussions at a later stage. I also note that the panel discussion outline has a type of May 4th, 2022, rather than 2020. We'll all be fine with that. Leons, please.
Yeah, sorry, it's not 2020, it's 2022. Thank you very much, Ricardo, for the nice, kind introduction, and thank you for hosting the event, facilitating the event. I apologize that I'll be asking our colleagues in Oxford to run my slideshow because I couldn't get the screen sharing working. So let's go to the next slide, please. This is collaborative work with a team made of Jim Boyce and I, who co-edited the book. But the chapters were edited by our colleagues. Adam Abubakar, who I think is in the audience, worked on the chapter on South Africa. Melvin Ayogu worked on the chapter on governance. Jan Merkar on the chapter on Cote d'Ivoire. Carmen, the chapter on South Africa, and Nick Jackson, who is going to be talking, worked on the chapter on Angola. Next. I want to take a minute to say a word of gratitude to the Open Society Foundations that funded this work, along with the FES in Berlin and the Political Economy Research Institute. We are grateful for insightful information from officials in governments and experts in the three countries during the course of the analysis. And thanks again for the Oxford Martin School for hosting the event, especially Professor Ricardo Suarez, the deliverer, for facilitating the event. Next. So this, in terms of the context, the work that we do on capital flight is couched in the context of a continent that has emerged from being referred to as a continent on the brink to a continent on the rise. But we wonder for whom it is rising, because it's also the same continent that is lagging behind in most of the development indicators, with the number of poor rising every day. So that means that the resources are not benefiting the people. In fact, they are being plundered by a network of takers and enablers, continuing basically the plundering legacy of the colonial and pre-colonial era. Capital flight is in fact a drain on resources that could be financing development. Next slide. The reason we care about capital flight is because the drain on the country's resources, which also deepens inequality in the sense that it's the elite, the richest, that actually is benefiting from capital flight. But in our analysis, especially the work that Nick has been doing, we show that the work shows that destination countries also suffer negative consequences, which we refer to as blowback, through the process of financialization and which takes over from real economic activity, but also the financing of illicit activities. The capital flight is basically an illustration of a phenomenon that we see as transnationalization of corruption and financial crime. It also undermines its effectiveness in the sense that some of the resources that are supposed to be channeled to investment in development are actually pocketed by the elite and transferred abroad in secrecy jurisdictions. Some of the loans that are given to African countries end up in financing capital flight through a revolving door, a phenomenon that Jim and I have documented for a long time, including in our first book on Africa's odious debt. Next. So the problem of capital flight has many dimensions that need to be analyzed. In our estimation, we find that Africa has lost over $2 trillion from the period from 1970 to 2018. And every year, the continent loses about $60 billion per year. And that's more than it receives in any other form of external financing, including official development aid, remittances, FDI. And the stock of capital flight, which is over 2 trillion, exceeds vastly the stock of debt, making again Africa a net creditor to the rest of the world, as we have always documented. The next, please. So, in terms of volume, impact on the economy, capital flight is a significant phenomenon. We decided in this book to profile 3 countries which share some common features that are of relevance for capital flight. In particular, the 3 countries exhibit severe underperformance relative to their potential. In the case of Angola, it's one of the biggest producers of oil, but half of the population lives below poverty. And for people who know Angola, they will tell you that Rwanda is probably one of the most unequal cities in the world, but very expensive because of the oil financing the elite and those who have access to power and economic involved in the economies of oil. In the case of Cote d'Ivoire, we profiled the case of cocoa, which is a big sector in the economy. It's the top producer of cocoa, but then the proceeds of the benefits from cocoa do not go to the producers who live below poverty, the poverty line, while laboring to produce this highly coveted product. In the case of South Africa, it's the most industrialized, diversified economy in the continent, but has huge mineral resources. But it's very famously or unfamously referred to as the most unequal country in the world. There are other unequal countries, but this is a very unequal country in the world. In the study on South Africa, we profile the phenomenon of state capture, where private corporations basically collude and to rob the state, to rob the people by milking state-owned enterprises, by inflating contracts, by transferring resources to wealth to offshore financial jurisdictions with the help of enablers, banks, accountants, law firms, and the like. In the end, we find that the efforts that the governments have undertaken to liberalize the economy, develop the financial system, have really not benefited to the ordinary citizen. Next, please. So in the case of Angola, we find that it has lost over $100 billion from 1986 to 2008. And we find a phenomenon where there is a large outflow of FDI. Most countries, you would see that they have net inflows of FDI. And this is because, as one journalist indicated to us, the rich Angolans don't live in Angola. They do business in Angola, they extract wealth in Angola, but they ship it abroad where they live. But that's also the case for multinational corporations. Natural resources have been used to enrich the private individuals, and they have actually caused an atrophy of the non-oil sector, a very classic case of resource curse. The wealth extraction and by the elite has been facilitated by global players, including foreign banks that are bankrolling the loans of elite families such as the president's family, and offshore financial jurisdictions and banks that facilitate the transfer and concealment of this wealth. Next, please. In the case of Cote d'Ivoire, again, we profiled the case of cocoa, where the farmers remain poor while the elite and multinational corporations accumulate wealth. Large quantities of cocoa cannot be traced. Cocoa is severely misinvoiced. and the whole sector is monopolized by rich, big multinational corporations. And ironically, this system has been perpetuated through the post-colonial era. So it seems that all the post-independence regimes are happy to maintain that system of exploitation of the Ivorian people. Next, please. In the case of South Africa, next, please. In the case of South Africa, we find that it also has lost a large amount of resources through capital flight. Over 326 billion fled the country from 1970 to 2018. The bulk of that goes through mineral export misinvoicing, including gold, which up to date, we have not been able to have a clear picture of the statistics of gold that comes into country and leaves the country, where it goes and how it is valued. The attempts to implement market-oriented policy reforms has not helped to rein in capital flight and attract foreign wealth held offshore. In contrast, the domestic institutions have really eroded through what is called state capture. There is a commission now underway that has been releasing reports. It's called the Zondo Commission, confirming what we have profiled in the book. And this is facilitated by a global network of enablers who enable corruption, state capture, and capital flight. Next. This chart will show you the multiplicity of players, including politicians, top politicians, including President Zuma and his family, connected individuals. We profiled the case of the family of the Gupta family, corporations, global corporations, or mineral corporations like Glencore and Trillion, and banks, both domestic and foreign banks that facilitate the transfer of the wealth from South Africa, and then foreign consulting firms that are in fact helping in cooking the books and hiding the tracks of the stolen money. Next, please. So in the end, what we find is a system of public plundering, not public-private partnership, but is the collaboration of the private individuals and public institutions to plan and individuals to plunder African resources, to enrich themselves and transfer the funds abroad, which could have been instead financing investment in infrastructure, education, and health. So when we see that Africa is trailing behind in terms of education and health, it's not because it does not have resources, it's because those resources are siphoned out of the continent into the secret banks that are hiding those wealth away from the view of the public. Next, please. So in the end, we realize that the problem of capital flight is not just a domestic problem, it's a global problem. So the nexus between plunder and capital flight is not purely an internal problem of African countries, nor is it purely an international relationship in which an imperial power preys on faraway lands as in earlier centuries. Rather, it's a transnational phenomenon that spans national boundaries, operated by a network of individuals and institutions who are bound together by mutual benefit and convenience, regardless of nationality. Thank you very much for listening. I yield now to my colleague Nick.
Thanks, Leonce, for that great presentation. So I'm going to just very briefly tell a little bit about my time in Angola. I actually lived in Angola from 93 to 95. I was the Reuters and Financial Times correspondent there. And then I continued kind of, excuse me, working on and writing about Angola for some years after that. The period that I studied was really the period of what you might call Angola's quadruple bonanza from 2002, when the war ended, to about 2014, when there's oil price crash. Basically, the quadruple bonanza was, big surge in oil production, very favorable oil prices. Number three was the end of the war, which was by far the biggest factor for the people of Angola in terms of benefits. And the fourth lesser factor, please excuse my coughing, I'm still recovering from COVID. The fourth factor was, which is a smaller factor, but still significant, was a large amount of reconstruction money, particularly from China. Over that period, Angola exported roughly $500 billion worth of oil. And I went in there to see, what the hell happened to all this money. One little vignette, it's just one of many things you could say about this period, which is quite depressing, is that at the outset of the period, if you look at IMF data, you can calculate that mineral resources, in other words, crude oil, refined oil products, diamonds, in large majority, made up about 99.5% of Angola's exports. That was at the beginning of the bonanza period. You would have thought that through that period, the economy would kind of grow and diversify, and it become a more, especially with the end of the war. But at the end of the period, that figure had not really budged. The Angola oil and minerals, and diamonds and so on, refined oil products as a share of exports was still above 99%. So Angola had not managed to diversify its economy. And it was, I think it is a classic case, an absolute poster child for the resource curse. And the resource curse is a phenomenon that I think is sometimes misunderstood. I think people understand quite easily the idea that, there's a lot of money comes from resources like oil, and the elites come in and take it away, and that money doesn't get used for development. And that's certainly the case in Angola. There's no doubt about that. That's what I would call the weak version of the resource curse. The strong version is that countries that are dominated by minerals tend to be even worse off than their resource poor peers, even worse off than they would have been without those minerals. So it's not just the money's being stolen and it's not being used, it's somehow harming the country. And that's absolutely the case, was the case for Angola for large parts of its recent history. You can always argue about counterfactuals and so on. But Angola was afflicted by, I would argue, the strong version of resource curse, particularly during the war. And I would argue, and this fits with a lot of the research, that the war itself was a function of the resource curse, or partly a function of the resource curse. It obviously had many fathers and reasons why it happened. But the resources, particularly the oil and oil financing the government and diamonds financing UNITA rebels, provided the resources to pursue the war and the motivations as well to continue the war. And also the kind of governance problems. That is one of the central features of the resource curses, and why it causes not just lack of development but harm, is that it generates so much governance trouble. You have money flowing in through the top of a political system, and leaders, people in positions of power, allocate resources downwards in exchange for political support, and that kind of creates the political structure, or at least it heavily influenced the political structure. It is a very, very different kind of structure from what a normal democratic economy would be considered. So that's the kind of the kind of context. If I have time to tell a couple of stories, I do want to, in the questions, I want to get into the issue of blowback, which has been mentioned earlier, because I think that if we're looking to talk about solutions, how to tackle these problems, at least on an international level, I think that is central to the answer, and it's very underexplored. But I won't have time in my presentation now, in my 10 minutes allotted. How many minutes do I have left?
About just 4 minutes.
4 minutes, okay. Well, I'll just tell two quick stories that are in my report about capital flight. One is the issue of exchange rates. When I was living in Angola and before then, and for quite a bit of the time, Angola had dual or multiple exchange rates. And in some cases, it was a huge divergence. So, a dollar might have bought 100 kwanzas on the black market out in the streets, or it might, but whereas the central bank might be offering it $1 for 10 kwanzas. So, so if you can get money through the central bank, if you can put in kwanzas and only pay 10 kwanzas to get $1, you can take it out and you can go onto the street and change it, and you get 100 kwanzas. So as if by magic, you've made money. And a classic way that this was done by quite reasonably large numbers of people in Luanda was through what was called the lojas francas, which was the kind of official stores. And these were kind of set up in order to keep urban populations happy, or at least the important parts of the elite urban populations that politically mattered to the MPLA. And basically, you could go into a shop and you could, with kwanzas, you could buy goods that were typically imported goods and put in a very small number of kwanzas at the favorable official rate. This was a way that a lot of, people, when I was living there were lots of stories of people who would, get a return flight to New York for the price of a crate of beer, that kind of thing. What this was state largesse. This was oil money at the end of the day, being handed out to favored clients. As time went on, the sort of number of clients who were able to access this got narrower and narrower. And eventually it was, it was the big importers and just a few, and their political support, their political protectors who really made all the money. And of course, a lot of that flowed out as capital flight. The point I wanted to make about that particular story is that there was nothing really illegal about using exchange rates in this way. You could make an enormous amount of money if you were well connected, manipulating exchange rates, putting money, from dollars to kwanzas and back again in a circle. But this was the official rate. This was what the system was. So it wasn't, it wasn't necessarily illegal money, but nevertheless, it was intensely damaging to Angola. The second example I would give is the Angola-Russia debt deal, where there was essentially after the Cold War, Angola had about $5 billion worth of debts to Russia, which had taken over the debts of the Soviet Union. And a restructuring was offered. They were going to restructure it down to about $1.5 billion, which was, probably great for both countries. But as this was being agreed, a middleman or an intermediary or a set of intermediaries inserted themselves into the middle of this deal. And they set up an offshore shell company called Abalone, which then put itself in the middle of all these payment streams. And suddenly, and there was a complicated financial arrangement involving 31 promissory notes, where notes were kind of, when debts were paid back, and this was paid back in cargoes of oil by Sonangol, the state oil company, notes were handed back to say that this money's been, been paid successfully. But these notes were sort of passed through this intermediary, and this intermediary walked off with hundreds of millions of dollars. And it turned out, and there were leaks, and people got hold of, the names of companies and names of people involved, and it turned out that money was flowing into the private accounts of, the president and all sorts of other figures in the regime. So that clearly is at a different part of the spectrum. It's much more kind of quasi-illegal. You could probably find Angolan laws that would say that's really not something that could be done. But still, it was sanctioned at the highest level. So again, this was money flowing out, and it kind of had official backing. It was capital flight, but if you start trying to nail down questions of legality and whether this was, for both the examples I've given, you quickly get nowhere. But large amounts of money sort of fled in that way. But so I'm going to wrap it up here. I'm just going to say that hopefully in the comments time we get a chance to talk about the blowback issue, which I think is to discuss. Thank you.
Thank you, Nick. Thank you, Jim.
Well, thank you very much, and thank you all for tuning in for this event, and thank you, Ricardo, for hosting it. I want to start by doing something that's sort of customary in these events, which is to read a couple of brief excerpts from the book. These are both from the conclusion, and they help to kind of wrap up some of the things that Leonce and Nick have already said, but also I hope will give listeners some sense of the tone and overall content of this book. And they underscore what I think is one of our central points here, which is the transnational nature of the phenomenon of capital flight. The idea that this is not simply an anomalous thing happening in Africa. It's not a few bad apples. There's something systemic and international going on here. So here's the first excerpt. In the make-believe world of the ideal neoclassical economy, capital flight from sub-Saharan Africa would be a cruel irony. In a fantasy world of perfect markets, abnormally high profits would arise only as a reward for productivity-enhancing innovations, a temporary bonus that disappears when other producers catch up. In a world of perfect property rights, assets would only change hands through voluntary exchanges at mutually agreed prices. Floating alongside this perfect market would be the perfect state, impartially enforcing the rules and efficiently providing goods and services, public goods and services. Natural resources like oil, hard minerals, and fertile land would be an unmitigated blessing, not a curse. Guided by the invisible hand of self-interest, capital would flow to investments wherever they yield the highest returns, and hence from places where capital is relatively abundant to places where it is scarce. The real world depicted in this book operates quite differently. Far from being perfect, markets are often riddled with imperfections. They routinely confer persistent excessive profits to those who wield control of choke points in the economy. Property rights are neither perfectly defined nor perfectly secure. Instead, powerful actors are guided, as if by an invisible hand, to opportunities for appropriation, capture, and outright theft. Governments are neither impartial nor efficient. Propelled by the interplay between power and wealth, their central objectives morph from serving the public to serving the elite. Natural resources are a hunting ground for rapid wealth extraction and accumulation, and capital flows across borders are driven not by relative scarcity, but by the relative secrecy available in offshore havens. In this all too real world, capital flight from Africa and other poor countries across the world, or more accurately, countries where most of the people are desperately poor, comes as no surprise. It is not ironic, simply cruel. The second excerpt I'll read pursues the theme that there's an international network that organizes this plunder, bound together, as Leonce mentioned, by mutual benefit and convenience, regardless of nationality. The markets for bulk commodities like oil, hard minerals, and cacao are themselves transnational institutions of worldwide scope. Were it not for global demand, production of these commodities would be a minor feature of African economies. In principle, as economists have long insisted, international trade can lift living standards among all trading partners, much as, in principle, Africa's resource wealth should be a blessing for its people. In practice, however, there's a fateful disjuncture between textbook principles and real-world economies. In exploiting the imperfections of markets and states, transnational plunder networks transform national borders from a constraint into a shield. The takers and their enablers move freely across borders, inhabiting a world of executive suites, gated communities, five-star hotels, first-class lounges, and private jets. In this world, local cultures are glimpsed, if at all, only as artifacts displayed by interior decorators. At the same time, the networks gladly seize the advantages that borders can provide for concealing wealth from national authorities. Borders act then as a semi-permeable membrane, allowing free movement of commodities, money, and people with the right credentials, but obstructing the reach of the rule of law. The takers are aided and abetted by enablers, global banks and financial institutions, auditors and accounting firms, consulting firms, and lawyers for hire. The enablers, too, are essential parts of the transnational plunder networks, along with the corporate and government officials they serve, and they share commensurately in the loot. Far from an anomaly in this world, capital flight is a feature of business as usual. So those are the two excerpts I wanted to share with you, and let me close by talking a little bit about some of the ways we might be able to attack the problem. Broadly, there are two strategies for addressing the issue of dirty money. One is an after-the-fact piecemeal approach, the kind of approach that we now see being used to try to track and seize the assets of oligarchs in the wake of the Russian invasion of Ukraine. But the problem of finding concealed assets is a difficult one. It's time-consuming, it's costly, and such efforts seldom manage to freeze more than a small fraction of the ill-gotten gains. The second broad strategy is quite different. It's a preemptive, before the fact, across-the-board effort to stem the massive influx of dirty money from throughout the world into offshore havens, including, very importantly, Western economies like those of my own country, the United States, or here in the UK. Rather than waiting for kleptocrats to cross a line, say by getting too much bad press or invading a neighboring country, this approach focuses on the systematic vulnerabilities that they exploit within the international financial system. It's important to understand who would benefit, including in the destination countries like the US and the UK, and who would be harmed by the latter preemptive systemic measures. The harm here in the destination countries would be restricted to the enablers, to the bankers, the lawyers, the brokers, the accountants who helped corrupt elites to shift and hide their assets, pocketing a slice of the loot for themselves in the process. This is a narrow but quite powerful stratum within our societies. The benefits of taking these kinds of systemic measures would be, of course, first and foremost to the people of the countries who are subjected to their misrule. But the benefits would also extend to the public in the countries that now serve as havens for dirty money. And I want to give three examples of this. This gets into the blowback issue flagged by Nick. Our book describes several of the repercussions from turning a blind eye to dirty money, as has been too often done in the past in the US, Europe, and other offshore havens. One example involves financial integrity and stability. In the case of Angola, for example, in the turmoil set off in European financial markets after the collapse of Portugal's Banco Espírito Santo, this was a scandal triggered in no small measure by the bank's unsecured loans to Angolan elites, money that was not productively invested in a way that would allow it to be paid back to the bank, of course. Second example involves real estate. The vast inflation of real estate prices in metro centers like New York, or so-called Londongrad here in the UK, has been driven by purchases from oligarchs around the world. And this inflation has made it difficult or impossible for local residents to afford housing in their own cities. A 2015 investigation by the New York Times revealed, for example, that more than 50% of luxury real estate sales in Manhattan were to offshore shell companies with anonymous owners. The names of the people buying this real estate aren't even known or registered with the authorities. A third example is the corrosion of the rule of law and the norms of democratic governance within and among nations. This is a corrosive effect that spreads across borders, much as the coronavirus spread across borders. And we find examples, and we discuss examples in the book of this in the US, in the UK, and in Europe. One example would be the influence of Angolan wealth on Portuguese political parties. Another would be the Elf Aquitaine scandal in France. Another would be getting more contemporary attention these days, the influence of Russian money on US and UK politics. Steps we can and should take to address these problems include the following, and this is where I'll close. The first is to enforce existing rules where they exist. Having rules on the books isn't enough. rules have to be enforced. For example, due diligence, or so-called know your customer rules for banks, were toughened in the US after 9/11 in the Patriot Act. Banks were required to file suspicious activity reports, or SARs, with FinCEN, the Financial Crimes Enforcement Network, a unit of the Treasury Department. But with only 300 employees receiving more than 2 million SARs a year, FinCEN lacks the resources to follow up, to enforce the existing rules. They should have the ability to follow up, not only on suspicious activity reports in theory, but also in practice. And this would mean devoting adequate resources to fulfill its mandate. The US has a far bigger economy and far bigger financial sector than, say, Australia or Canada, who have similar sized financial investigation units. The US ought to have a size and budget to match. Today, once a bank files a suspicious activity report, it's free to do business with the questionable customer. It has fulfilled its obligations under the law. Meanwhile, most of the reports, the suspicious activity reports, which, by the way, are not publicly available, though they should be, gather the digital equivalent of dust. The second thing we could do is close the loopholes in the existing rules. The rules are full of loopholes. For example, the Bush administration exempted from the due diligence reporting requirements under the Patriot Act sales of real estate, luxury goods like planes and yachts and diamonds, investments in trusts, hedge funds, and private equity funds. Here, people are perfectly able to remain anonymous as they acquire these assets. Those loopholes should be closed. The US today in the Tax Justice Network's Financial Security Index is ranked number 2 in the world, partly because the US doesn't share its bank information with other countries, as they are compelled to do with the US under current law. Certain states in the US, like South Dakota, have really thrown out the welcome mat for dirty money. In South Dakota, drawing so much money that conventional offshore tax havens are complaining that this is unfair competition. The final thing we need to do is take down the enablers. We need to recognize that aiding and abetting criminal activity is itself a criminal activity and ought to be prosecuted as such. Fines on financial institutions and other enablers should be high enough to be more than symbolic. They should obliterate the financial incentives rather than merely acting as a peripatetic toll gate. And the individuals involved should face personal penalties, including prison terms, so that they're not shielded from these penalties by a corporate veil, the nanny corporation being the private sector equivalent of the so-called nanny state. So in conclusion, as we describe in the book, a lot has been done over the last 20 years to recognize, raise awareness of, and indeed address the problems of illicit financial flows and capital flight. There's been significant progress since the turn of the century. But, and this is what we underscore in the book, there's a lot more that remains to be done. And it is in the interests of the majority of people throughout the world, not only in Africa, but in the destination countries as well, to come to grips with these transnational plunder networks and rein them in through the rule of law. So I'll stop there and we'll open it up to questions, I hope, from the audience.
Thank you, Jim. Thanks to Leons, to Nick as well for these 3 excellent presentations, which I've read the book closely. They really foreground many of the key themes in the book. In addition, the book is very exciting because of the empirical evidence that undergirds these arguments and really show in an unequivocal way the extent to which the capital flight is harming African economies. I'm going to start by a question that we got. First of all, let me just remind the audience, we have many people in the audience. We have about about 60 people following us today. And I would just like to remind many of you that we have the Ask a Question button at the bottom, and that's where you should write your questions, and then I'll do my best to follow those questions. Let me ask, first of all, I should start with Leon's, but this is a question that perhaps all three of you would like to address. There's a question from Jacob Hensing, who says, thanks. Could you highlight a few suggestions for concrete steps that policymakers in advanced economies should take in the short term to help ensure that windfalls from the current oil price hikes are not squandered again? And this is a reference to the oil price increases since the start of the Ukrainian war, which is turning out to be yet another windfall. I don't know, Leo, would you like to start, or is that a question? Yeah.
Thank you very much. That's a great question, because again, in this book we profile one of those countries that happen to be rich in oil, and one of the messages you get from the analysis is that those commodity booms have come and gone without leaving anything to show for the ordinary citizen. Again, now that the oil prices are high, you would imagine that these countries are collecting increased revenues, even as those that are oil importers are suffering dearly with high prices. So one way to ensure that these high oil prices benefit the exporters is that the revenue are first reinvested in the economy, and secondly that they are saved, because what you find many times is that the governments are very exuberant in their spending, and when the oil prices rise, their expenditures rise, and some of those expenditures are not investment expenditures, they are consumption expenditures, in addition to the fact that a good chunk of the money is embezzled and end up in secret jurisdictions. The other concern for vis-a-vis benefiting from high oil prices is that the benefits also accrue to the multinational oil companies, not necessarily to the government. So the government gets the rents that are bargained with multinational corporations, and sometimes those rents are really tilted in the favor of the multinational corporations. The other issue is that even as these countries are exporting oil, you actually don't see a proportional accumulation in foreign exchange reserves. Once again, because some of the oil is misinvoiced, some of the revenues are not repatriated. Therefore, the countries actually don't benefit from these price booms. So that means that there needs to be increased transparency in the trade statistics for natural resources, including oil, so that each barrel is identified, where it is going, how much money it's generating, and how much money the country is benefiting. And we should see that trickling into the central bank's foreign exchange reserves. We need the civil society to ask questions and to keep an eye on these revenues, and countries should provide clear reports about what revenues are being received from these resources and how the revenues are being used. I don't know if Jim and Nick want to chime in.
Nick, do you want to chime in there?
Yeah. So. Okay, that's a very good question and a very big question with a very long answer. So I'll try and be as short as I can. Back in about a bit less than 20 years ago, I did a pair of reports for the UK government, and these were part of a project called Drivers of Change, which was looking at how. So here's a country, Angola, with loads of money being generated by oil, but terrible development outcomes. Is there a way that the British government can have influence in Angola to somehow nudge some of that, those revenues towards pro-poor spending, towards development spending? And after exhaustive investigations, I mean, it was clear to the team that worked on this that the openings for influencing what happens in Angola were very, very narrow, partly because of a long history of malign Western interference in Angola's international affairs and terrible economic advice, and feeding the rebel movement during the war, stuff like that. There's an awful lot of anger, but also oil money insulates elites. And insulates the government and leaders from having to do anything, except only when oil prices were really, really low and Angola was in a terrible crisis situation in the late 1990s. There did seem to be a bit of an opening, and they were starting to open up to do things that the IMF was asking it to do. But as soon as the money came back, they're just like, no, your advice is terrible. Right, it was terrible advice, most of it, not all of it. So the point is, if you're asking what can Western countries do to influence outcomes here, it's very hard to get change in the country, in Angola. A lot of finger wagging. You guys must be less corrupt. Okay, fine, but that's not gonna get us anywhere. We have to look back towards ourselves, and ourselves in the West. And I'm a British person, and looking back towards my country. And I think and although the question did ask about short-term measures, I think this is really a long-term problem. And for me, the problem is to go very deep into what's happening in the West and in Western democracies, and really change an entire ideology that is welcoming dirty money. It's an ideology that goes under different names like competitiveness and so on. We want to attract dirty money. So I think most British people, and probably most British politicians as well, don't like the idea of Africa being looted by their leaders. They think it's kind of repellent, and rightly so. But on the other hand, they know that a lot of the money's coming into the City of London or to the British tax havens, and they think, well, the money's coming in, so that's good for us. And that's a recipe for doing nothing. And I think the only way is to start focusing on this issue of blowback. And how this money, the inflow country, so Angola is an outflow country, United Kingdom or United States or Switzerland or Luxembourg are inflow countries where dirty money is coming in, capital flight is being received. And people just, I think most people have the idea, oh, well, money's coming in, that must be good for us. But in fact, this money generally isn't good for us. It's good for a section of our societies, and it harms other parts of our countries.
Now, a blowback perhaps towards the end. Thanks. I just want to keep it to this. We have about 10 questions to go through.
Yeah.
But we'll come back to the blowback issue in a second.
Yeah.
Jim, do you want to add something to this?
Just quickly, since the question referred to short-term measures that could be undertaken in advanced countries, I should mention that, of course, windfall profits from the current high oil prices are reaped, as Leonce mentioned, in considerable part by multinational oil companies. The profits being recorded by these firms now in the United States are enormous profits, at the same time that consumers are being hit by the effect of very high fuel prices. The response of the government is to wring its hands and talk about increasing fuel supplies. But another response, and I think an entirely appropriate one, would be to tax these windfall profits. And indeed, a bill has been proposed to do precisely that, led by Senator Sheldon Whitehouse in the Senate. Taxing these windfall profits, and as Whitehouse has proposed, redistributing the money from the tax directly back to the public in the form of equal per person dividends would be an excellent way to protect the well-being and standards of living of the people, of ordinary people, while at the same time diminishing the incentive for these massive energy companies to continue their predatory fossil fuel production game, and instead start to think more seriously about what they pay largely lip service to, which is invested in alternative energy and the clean energy transition. It could also help to set the stage for a policy of putting a cap on the amount of fossil fuels we allow into the country, auctioning the permits, and redistributing the money to the people as equal per capita dividends, something that I've also written about. So I think there are short-term things that can and should be done. The current extraction of wealth, not only from the people of Africa, but from consumers in Western countries and other countries around the world by these really cartels that control one of the key choke points in the modern world economy, are just blatant at this particular moment in time and cry out for creative responses.
Thank you, Jim.
Follow that up with a 60-second endorsement of what Jim said. Jim is not only a world expert on capital flight, he is also arguably the world expert, the leading global voice on this proposal of carbon dividends. I would urge everybody to look at this proposal, look him up, James Boy's carbon dividends, because I thoroughly endorse it. I think it is an absolutely game-changing and short-term policy. Sorry for interrupting.
Thank you, Nick. We have quite a lot of questions, so I'm now going to target specific questions at each of you, because we really have a lot of engagement here from the audience. Leons, we have a question here. We have a question from Matthew Danse, who asks, thank you for the proposals on what can be done, much as they will be effective. I think he's referring here to the proposals that you mentioned. Do you think getting the people from these countries involved themselves would be more effective? I think this is setting up, local political change in African countries themselves as an alternative to sort of the global systemic reforms that the three of you mentioned during your presentations. Leons?
Thank you very much. That's a great question, and I want to preface it with the conclusion that Jim emphasized, that any solution to the problem of capital flight has to be a global solution. It involves things that need to be done in Africa at the source and things that need to be done globally at the destination, as Nick also has emphasized. So in terms of the what needs to be done in Africa, yes, I think we need to see more space opening for civil society to participate in the debate about how to better manage natural resources. There are, in fact, some very good initiatives that have been undertaken by the United Nations Economic Commissioner for Africa, the African Union, in terms of charting a strategy for better managing natural resources. What needs to be done now is actually implement those strategies, and in the way of in the courses of implementing those strategies, there should be more space provided to the public to, first of all, learn more about what are those resources, because many times you find that people actually don't know how much resources they have. People will tell you this country has oil, this country has gold, but if you say how much, they actually don't know, which means that the plundering can continue without people knowing. The other is people do not know how much money is coming out of those resources. Governments should be required, along with the multinational corporations, to disclose clear, detailed statistics about how much production, exports, and revenue is coming out of those resources, and how much it's coming to the government in terms of taxes and foreign exchange earning. Because I keep insisting, just because you produced copper or oil does not mean you have the dollars, because the dollars could stay in the hands of the corporation. You need to sell the copper, you need to repatriate the revenue, you need to get the dollars in the hands of the banks, of the central bank and the commercial bank. And for that to happen, I think the public has the right to know and to participate in crafting a strategy and implementing the strategy. Transparency at all ends. Thanks.
African publics, but following from what you said about African institutions, from the vintage point of 2022, what I find particularly worrisome is that this agenda is now perhaps more visible than it has been before, but there's no obvious African leadership on the agenda. The AU, the African Parliamentary Group sometimes, but for instance, an institution like the Economic Commission for Africa, which 7 years ago, as you remember, co-led on the so-called Mbeki report on illicit financial flows out of Africa. The Economic Commission for Africa is essentially silent these days. It's not a key player on the illicit financial flows agenda. And we see a situation in which organizations like the OECD, ironically, for obviously self-interested reasons, but also UNCTAD, seem to be playing up a role in this regard. Again, I'm not saying anything positive about that role because there's a complexity to that, the role of external institutions. But the absence of such strong African leadership, is it bluntly put, because too many African leaderships are at least ambivalent about this agenda? Or are there any other reasons that you point out for the lack of salience of an African institutional leadership in regard to the capital flight agenda? And again, I don't wish to underplay the efforts that you did mention and which do exist and which are important.
I think there is a great opportunity for African institutions to play a bigger role. I think the initiative spearheaded by Mbeki, which I was fortunate to be informed and participate a little bit at the beginning, was a great innovation, and it still provides a framework for galvanizing the debate on illicit financial flows and what can be done. I have to admit, I haven't had recent interactions with the leadership of that outfit, but I would hope that they will be more visible, more energized. And if any of those Western institutions that want to intervene in helping to resolve this problem, I would encourage them to join hands with African-based institutions like the high-level panel on illicit financial flows, the African Economic, the Africa Union, and in the context of the agenda on natural resource management. One ways in which the Global North could help is in the area of capacity building, because many times you find that these governments are shortchanged because they simply do not have the capacity to negotiate good contracts. They don't have the capacity to monitor those transactions, and that capacity can be built through investment in training, formal training, but also on-the-ground training, supporting institutions like the international financial units in central banks or the research departments in central banks. I think we should encourage more collaboration between the OECD outfit that's working on tax with the African economy, with the African Union and the Economic Commission for Africa to craft a strategy and also implement a strategy for really keeping those resources onshore, because it's not effective for Europe and the US and Canada to say we're going to increase aid to Africa. We want to support Africa in development at the same time where they are welcoming dirty money coming from the continent. It does not make sense.
Thank you, Leos. I have a question here for Jim. Great presentations and music to our ears at the U.S. Financial Accountability and Corporate Transparency Coalition, the FAC Coalition. This is Ian Gary. Hi, Ian. How should the Biden administration use the forthcoming U.S.-Africa Leaders Summit to push a common reform agenda in this arena?
Really great question. And I suspect my questioner would be able to give a better answer to this than I have. The FAC Coalition, for those of you who don't know, has really played a leading role in bringing together multiple organizations working on issues of transparency and anti-corruption, anti-money laundering activity. I think the Biden administration potentially faces some great opportunities to move this forward. Unfortunately, without much cooperation from the other side of the aisle in Congress, doing so has proven to be quite difficult. But one example that I'll mention is a bill which does have bipartisan sponsorship in the US called the Enablers Act, which is a bill that would try to close some of the major loopholes, including those I mentioned, that allow anonymity to persist in real estate transactions, in deposits of assets in trusts and private equity funds and so on in the United States. I think it is possible to build bipartisan support for a crackdown on dirty money precisely because for the majority of people in the country, dirty money is a problem and not something that they personally benefit from. It's only a small stratum of the population that really gains from this, even though they attempt to claim that the benefits trickle down to the rest of us. It's clear that they don't. Now, in terms of interactions with Africa, I think one of the key things that we could do in the US to enhance our credibility and to really come across not as preaching and as a bunch of hypocrites, but instead as people who really want to be, and governments who really want to be part of the solution, is to get our own house in order. And that includes taking these steps to roll up the welcome mat that we've rolled out in the past for dirty money from Africa and elsewhere. But it also includes taking steps to support and enable the courageous institutions, including journalists and others in sub-Saharan Africa, who have really been at the forefront of the effort to expose what's going on. We ought to be helping to protect these people, defend them, and encourage their governments to take to really welcome the light they shed on this whole underside of the global financial system, rather than, as is too often the case, trying to shut them down and shut them up. So I think there is really scope for moving forward on this. There are people who want to do it. There are people who are doing it, courageous people who are doing it, and they deserve all of our support.
Thank you, Jim. We're getting to the last bit of our event today, and I'm just going to ask a question for Nick. Nick, if you could answer it. It's a difficult question to answer briefly, but then I want to go back to all of you on the issue of blowback. So, but the question, and I'm paraphrasing somewhat, a question by a participant called Maxime Mazout Lohol, which has to do with whether the sort of work that you've done is being done on economies in South America and in South Asia, I assume East Asia as well. But most importantly, I think, and this is my adding to the question, is has the fight against capital flight in other parts of the developing world been more successful, or is the portrait that you're establishing for the purposes of this book is an Africa-centered portrait? Whether is there more positive dynamics elsewhere, perhaps as the product of public policy on the part of global South states? And you did both. All of you said that the problem is systemic and global, but are there variations, and is there a pushback elsewhere that Africa can perhaps look at? And I'm just going to ask this question from Nick, but I'm aware that both Leonce and Jim might want to say something about this as well. Nick.
Okay, thanks, Ricardo. I'm actually going to talk about blowback. I'm going to follow directly on from Ian Gary's question and the Fact Coalition, because I had already been planning to put together a quote about an amazing achievement of the Fact Coalition in the United States to tackle what I would call inflows, to crack down on dirty money flowing into the United States. And this was, I believe it was called the Corporate Transparency Act. In their report, they brought together a coalition, and I'm quoting them now, that involved hundreds of national security experts, police and prosecutors, banks and credit unions, CEOs, the real estate sector, large businesses, small business owners, faith groups, anti-human trafficking groups, human rights organizations, global development NGOs, anti-corruption advocates, labor unions, and conservative and liberal think tanks. That's the coalition that they put together to bring in to bring together this sort of anti-inflows piece of legislation, which was, it was not the end of the story. There's always more that needs to be done, but it was a real achievement. And I think it's very interesting that you get such a coalition across the political spectrum from left to right, recognizing the dangers of dirty money on many levels. And I think now is a particular moment, obviously, with what's going on in Russia. There is, obviously some crackdown going on, but I think we have a political moment that where this is in people's minds now. And I think pushing forward what we can in terms of cracking down on inflows. There's one other quick thing I would say about that. There is a lot of research. It is contested, but it is fairly solid. It's in the academic literature, it's called Too Much Finance. And basically this is showing that many countries, including the UK and the US, have financial sectors that are too big for their own countries and doing the wrong things. And that there's a kind of paradox at play here, a little bit like the paradox of the resource curse, where too much money is kind of making us poorer. It's reducing GDP growth in these countries. It's reducing prosperity, having too much financial centers too big. And this literature is basically showing if you shrink these financial centers back down to the sort of where they're doing the things they're supposed to be doing, and getting rid of this stuff, you will actually have higher GDP growth. You'll get a more prosperous economy. And I think in this story, there's a lot of work still to be done on it. There is a great political possibility to harness across the political spectrum from left to right, political energy to crack down on these kinds of dirty and harmful and abusive inflows that we've been talking about today.
Nick, just one question on the issue of non-Western fight back. Is there anything to be said, or is it really not much there by way of successful global South policy on this outside Africa? Is there? I mean, if nothing comes to mind. Nothing
immediately comes to mind, but I'm just kind of trawling my memory, so I don't want to give a definitive answer on that. I think, in so many of the international initiatives that you see, it's power at the end of the day. I mean, if you look at what's happening in tax policy, for example, for so many years, the OECD has overseen the international tax system, and that has effectively been a tax system that has favored the interests of rich and powerful countries, and it has disfavored poorer countries. And I think countries like Brazil that have some power will fare better in this international tax system than, say, Malawi, but of course they don't fare nearly as well as the United States. And so I think this power imbalance is kind of embedded in all the institutions and structures that are out there. But in terms of specifics, like what to point to now, I can't think of something that would illustrate anything very interesting, so I'll leave it there. Perhaps anyone else have some.
Briefly address first the question on non-Western experience, or not, but most importantly, the blowback that I mentioned that Nick alluded to. If you're trying to convince specifically Western audiences that this is an agenda they should care for, without any resort to altruistic arguments about the plight of Africa, would be the key arguments you deploy. And Leon, so I would ask the same questions from you, and we'll move on from Jim very briefly, Jim, if possible, to Leon, and then we'll close there.
Yeah. Okay. Well, I will try to be uncharacteristically brief, Ricardo. The phenomenon of capital flight and illicit financial flows is by no means restricted, of course, to Africa. There have been tremendous outflows from Latin America and Asia. I myself first became aware of this and began working on it back in the 1980s and 1990s when I was writing a book about the Philippines and the plunder that took place under the Marcos dictatorship there. So it's a problem that Africa shares with other regions of the global South, and a problem that is particularly acute in countries that are well endowed with natural resources, or countries that have been favored with easy access to international loans, which are among the most lootable of resources. In terms of positive experiences or efforts, I would just mention one particular issue on which there has been some positive pushback, and that has been in Korea, South Korea, and in Malaysia, partly in response to the international financial turmoil, the periodic crises. There has been a deployment of capital controls, which are different from foreign exchange controls. Foreign exchange controls refer to efforts to manipulate who gets access to foreign exchange at what rate. Capital controls mean efforts to stem the outflow of capital, including illicit as well as licit outflows. And those capital controls in Korea, where they were, the penalties included the death penalty, and in Malaysia, were fairly effective, I would say, at stemming outflows, especially during the financial crises that hit East Asia in the past. And those experiences led the IMF, among others, to reevaluate their views on capital controls and begin to recognize that these could be an important part of the toolkit for macroeconomic management. On the issue of blowback, I would say easiest just to re-underscore the examples I mentioned. The blowback in terms of financial instability, the blowback in terms of inflated real estate prices in metro centers and that impact that has had on people's living standards, and the blowback in terms of corrosion of our political institutions and norms of governance. All of these are very dramatic examples of ways in which this is a problem, not only for the people of Africa and other countries in the global south, but also for people in the advanced Western economies that have been so open to letting dirty money in with few questions asked. Nick's book that you mentioned in the introductions, Ricardo, on the finance curse, goes in some detail to this issue. And since he did me the favor of plugging my work on carbon dividends, I want to plug his. We didn't agree in advance to do this, so this is spontaneous and genuine. But I want to plug his book, The Finance Curse, on this topic as well.
I wasn't aware of this mutual plugging, but it's all fine. Leons, on that note, I'd like to give the final word on these issues. If you could be relatively brief, we have to wrap up.
Yes, and I wasn't in the room when they were agreeing on that collaboration. Okay, so I think the issue of blowback is a very good hook as how we can motivate and energize a debate on why the global north should care about resource plunder from the south. In addition to what Nick and Jim just said, I want to take on to add on the issue of tax evasion and tax avoidance by multinational corporations in the countries where they work, where they exploit those resources. They pay no taxes. Okay. Now, what does it mean for the ordinary citizen in Europe and in the US? It means that the ordinary citizen is basically subsidizing, because they don't pay taxes here also. It basically subsidizing the infrastructure, the services that these companies are using to earn money. So because they're not paying taxes and because services need to be provided, the ordinary citizen need to seize their tax burden increases over time. The other is on the financial system. You remember how everybody was excited about this idea of preventing minerals like diamonds that are exploited with the slave labor, blood diamonds, and so on. I think we should be talking about blood finance and blood equity and blood stocks. When you buy a stock from a company that's exploiting and plundering resources in Africa, you are also responsible for that exploitation. So we need transparency. We need to make the public in the US and Europe aware of how their money, how their investments are being used by the companies that they are investing in. just as, for example, people now are very, very interested in knowing that they are not investing in companies that are polluting. They are more interested in investing in companies that promote renewable energy. We should also promote investments in companies that are clean of corruption and plundering. Thank you.
Thank you, Leos. On the trail of capital flight from Africa, you can find information and a special code for those of you who want to acquire the book at a discount at the bottom of the screen. Leons Ndikumana, James Boyce, Nick Jackson, thank you so much for being with us today. Thank you. And thank you to the audience.
Thank you, Ricardo.
Thank you, Ricardo. Yeah.
Thank you very much. Thank you.